Silver just dropped, and the internet is losing its mind. Half the people in every trading forum, every financial comment section, every precious metals group are screaming, "Buy the dip, this is the opportunity of a lifetime, back up the truck, load up before it explodes higher." The other half are saying, "Don't touch it, the crash is coming, this is a dead cat bounce, silver is going to $30, maybe 25, maybe lower." Both sides sound completely convinced. Both sides sound like they know exactly what's going to happen next, and both sides cannot be right. So who do you believe? And more importantly, what do you actually do with your money right now? Because this is the moment that separates the investors who build real wealth from the ones who just talk about it. This is the decision point, and if you get it wrong, if you buy too early into a falling knife, or if you wait too long and miss the real move, the cost isn't just financial. It's psychological. It's the kind of mistake that makes people swear off investing altogether. So stay with me. Because by the end of this video, you are going to have a clear, structured, intelligent framework for making this decision. Not based on emotion, not based on noise, based on the actual market mechanics that determine where silver goes from here. Let's get into it. First, let me describe exactly what's happening right now, because I want to make sure we're all looking at the same picture. Silver ran hard. We're talking about a move that took the metal from the low 30s up through 35, through 38, and into the $40 range. That was a powerful, fast, fundamentally driven move. Tariff shock, supply fears, inflation concerns, monetary instability, all of it converging at once and pushing silver higher at a pace that shocked even the bulls. And then, the pullback. Prices dropped, sharply, fast. The kind of move that feels violent when you're watching your portfolio in real time. The kind of move that makes your stomach tighten and your finger hover over the sell button. And right now, sitting in that pullback, investors are frozen. They don't know if this is a healthy correction inside a larger bull move, the kind that shakes out weak hands before the next leg higher, or if this is the beginning of a genuine reversal, the kind that turns a winning trade into a painful loss if you stay in too long. That confusion is completely understandable. And it's also extremely dangerous, because confusion leads to inaction, and inaction in a fast-moving market has a cost just as real as making the wrong move. So let's cut through the confusion with some structure. Here's what most people miss when they try to answer the buy the dip versus wait for the crash question. They focus entirely on price. They look at a chart, they draw some lines, they pick a number, $35, $32, $28, and they say, "That's where I'll buy." Or they look at the price drop and they say, "It's already fallen enough, it must be time." But price alone tells you almost nothing about what silver is going to do next. What tells you something is the reason behind the move. Because not all dips are the same. Not all pullbacks have the same DNA. And understanding what is actually causing this pullback, not just that it's happening, but why, is the only way to make an intelligent decision about what comes next. So let's break it down, step by step. Because this is the part that most retail investors never get taught. Step 1. Understand what kind of pullback this actually is. There are three types of pullbacks in any commodity market. The first is a technical correction. This happens after a fast move higher, when the market becomes what traders call overbought, meaning prices ran too far too fast, ahead of the fundamentals. Momentum players take profits. Short-term traders exit. The price drops, sometimes sharply, but the underlying fundamentals haven't changed at all. The bull case is completely intact. This kind of pullback is the classic buy the dip setup. The second type of pullback is a sentiment shift. This happens when the news cycle changes. The scary headline that drove prices higher fades. A deal gets announced. A crisis appears to be resolved. The emotional urgency that pushed investors into silver dissolves, and the hot money that came in fast leaves just as fast. Prices can fall significantly in a sentiment shift, sometimes back to where they started before the news. But again, if the structural fundamentals are still in place, this is also ultimately a buying opportunity. It just requires more patience and more conviction. The third type of pullback is a fundamental reversal. This is the dangerous one. This is where the underlying reasons for the bull move actually change. Supply problems get resolved. Demand collapses. A major policy shift removes the catalyst entirely. This is the crash that the bears are warning about. And this is the one where buying the dip turns into catching a falling knife. So the real question, the only question that matters right now, is which type of pullback is this? And here's my honest answer. Based on everything the data is showing right now, This looks far more like type 1 or type 2 than type 3. But let me show you exactly why I say that, and more importantly, let me show you the specific conditions under which that assessment could change. Let's look at the structural case first. Because the fundamentals that drove silver to $40 did not disappear when the price pulled back. The silver supply deficit is still real. The gap between global silver production and global silver consumption has been negative for 3 consecutive years. Mining output is not surging. If anything, the tariff situation has made the supply chain more complicated, not less. The industrial demand from solar, from semiconductors, from defense technology, that demand is not slowing down because silver pulled back a few dollars. In fact, some industrial buyers who were priced out at $40 are probably quietly grateful for the pullback because it gives them a chance to lock in physical supply at slightly better prices. The monetary situation is still real. The Federal Reserve is still trapped. The debt is still $34 trillion and growing. The dollar is still facing long-term structural questions about its reserve currency status. None of those things changed because silver dropped from $40 to wherever it's trading right now. The geopolitical situation is still real. The tariff is still in place. The trade tensions are still elevated. The realignment of global economic power away from dollar-dominated systems is still proceeding. None of that changed. So when you ask whether the fundamentals justify buying this dip, the honest answer is yes, the fundamentals still support a significantly higher silver price over the medium to long term. The structural case is intact. But here's what most people miss. Fundamentals tell you the direction. They do not tell you the timing. And timing is everything when you're deciding whether to buy right now or wait. Let me give you some historical context, because history shows this pattern again and again, and it's genuinely instructive. Think about what happened to silver in 2011. Silver ran from around $18 all the way to nearly $50, one of the most dramatic commodity moves in recent history. And then it crashed. Hard. Within a few months, silver was back at $35, then $28, then $26. By 2012, it was sitting below $30. By 2015, it had fallen all the way back to $13. Now here's the painful part of that story. The people who bought silver at $40 in early 2011 because the fundamentals were strong, because there was monetary instability, because quantitative easing was expanding, because industrial demand was growing. Those people were not wrong about the fundamentals. They were wrong about the timing. And the difference between being right about fundamentals and right about timing cost them years of sitting underwater in a position that felt like a mistake even when it wasn't. Now think about what happened to silver in 2020. Silver collapsed from $18 to $11 in the March crash. The people who said the crash hadn't finished, who waited for a lower low that never came, those people missed one of the fastest recoveries in commodity history. Silver went from $11 to nearly $30 in just 4 months. If you waited for the crash to finish, you waited through the entire move. The lesson from both of these episodes is not that one approach is always right. The lesson is that the decision to buy the dip or wait for a bigger crash depends entirely on where you are in the larger macro cycle. In 2011, silver was at the end of a multi-year bull run, hitting resistance against an unchanged monetary environment. The Fed was moving toward tightening. The emergency buying of the financial crisis was fading. In 2020, silver was at the beginning of a new monetary expansion cycle, with the most aggressive money printing in history just getting started. Which situation does today look more like? Here's the uncomfortable truth. It looks more like 2020 than like 2011. But it's not identical to either. And that nuance matters enormously. So let me walk you through why this time is structurally different, in a way that shapes the buy versus wait decision. In 2011, when silver crashed from $50 back to much lower levels, the Federal Reserve still had credibility. It was still capable of raising interest rates meaningfully. It still had policy space to respond to inflation. The dollar, while weakened, was not facing an existential challenge to its reserve currency status. Central banks around the world were not systematically diversifying away from dollar assets into gold and silver. Today, none of those things are true. The Fed has dramatically less policy space than it did in 2011. Interest rates are already elevated, and the economy is showing stress fractures in commercial real estate, regional banking, and consumer credit. The Fed cannot raise rates much further without triggering a financial accident, but it also cannot cut rates without potentially reigniting inflation. This is the trap, and silver historically performs extremely well when central banks are trapped. Central bank gold buying and to a lesser extent silver accumulation, is happening at a scale that has no modern precedent. This is not speculative retail buying. This is sovereign-level portfolio reallocation. Countries are making the decision at the highest levels of their financial systems to reduce dollar exposure and increase hard asset exposure. That is a structural tailwind for silver that did not exist in 2011. The industrial demand story in 2011 was not what it is today. The solar energy transition, the electrification of transportation, the AI hardware build-out, these are demand drivers that are orders of magnitude larger than what existed 15 years ago. Silver is not just a monetary metal anymore. It is a critical industrial input for the technologies that are defining the next 20 years of human civilization. That demand does not reverse because silver had a short-term pullback, and the supply situation today is structurally tighter than it was in 2011. The mining industry underinvested in new capacity for years when silver prices were low. That underinvestment cannot be reversed quickly. New mines take a decade to bring online. The supply response to higher prices is slow and expensive. The deficit compounds. All of this means that the structural floor under silver today is higher than it was in 2011. The conditions that caused that 4-year bear market are not present in the same way today, which means the risk of buying this dip, while real, is not the same kind of risk it would have been in 2012. But I also have to be honest with you about the bear case, because the bears are not making things up. They have real arguments, and you need to understand those arguments, not to agree with them necessarily, but to know what you're watching for. The primary bear argument is this: if the tariff situation gets resolved, if a deal gets done, if Mexico makes concessions, if the 25% tariff gets walked back or significantly reduced, then the primary catalyst that just drove silver to $40 disappears. And in a market where a lot of momentum buyers and short-term traders piled in specifically because of that catalyst, the unwind of that trade could be sharp and painful. There is genuine merit to this argument. Tariffs in the Trump era have historically been used as negotiating leverage, not just as permanent policy. There is a real possibility that the Mexico tariff gets modified or removed in a negotiated settlement. And if that happens, the hot money exits silver fast. The second bear argument is about the broader economy. If we enter a genuine recession, if the economic slowdown that many economists are warning about becomes a hard landing rather than a soft one, then industrial demand for silver could fall sharply. Recessions historically hit industrial metals harder than monetary metals. Gold holds up well in recessions because it's a pure store of value. Silver, which is both an industrial metal and a monetary metal, can fall significantly if industrial demand collapses. These are the two conditions you need to watch for: tariff resolution on the Mexico front and a serious deterioration in economic data that signals a hard landing is coming. If both of those things happen simultaneously, the bears could be right, and in that scenario, waiting for a bigger pullback would have been the smarter move. So what are the specific indicators you should be watching right now to help you make this decision intelligently? The first indicator is the pace of the pullback itself. A healthy correction in a bull market tends to be slower and more orderly than the original move up. If silver is falling at the same pace or faster than it rose, that suggests the selling pressure is more serious than a simple technical correction. Orderly, gradually slowing pullbacks are bullish. Fast, panic-driven declines that show no sign of stabilizing are a warning. The second indicator is physical silver demand during the pullback. When silver prices fall in a genuine bull market, physical buyers, coin dealers, industrial procurement teams, central banks increase their buying. You should see premiums on physical silver stay firm or even rise during a paper market pullback. If physical demand dries up at the same time paper prices are falling, that's a warning sign that the selling is more fundamental than technical. The third indicator is gold's behavior. Gold and silver move together in most macro environments, but silver leads gold in both directions during extremes. If gold is holding firm or making new highs while silver is pulling back, that strongly suggests silver's pullback is technical and temporary. If gold is also selling off hard at the same time as silver, the macro environment may be shifting in a way that's less favorable for both metals. The fourth indicator is the dollar index and the bond market. Watch Treasury yields. If yields are rising because the market is pricing in more Fed tightening, that creates a headwind for silver. If yields are falling because the market is anticipating a Fed pivot, a shift toward easier monetary policy, that is rocket fuel for silver. The bond market is the most important signal in the entire financial system right now. Watch it every single day. So let me give you a direct, honest answer to the question this video asked. Buy the dip or wait for a bigger crash? Here is the framework I would apply if this were my own money. If you have no silver exposure at all, no physical metal, no silver ETF position, no mining stocks, then this pullback is an opportunity to begin building a position. Not to go all in, not to bet the farm, but to begin. Because the structural case for silver is intact, the supply deficit is real, and the monetary environment is genuinely favorable for hard assets over the medium to long term. Waiting for a perfect entry point in a market this volatile is a strategy that often results in never entering at all. If you already have a silver position, and you're sitting on gains from the move up to $40, this is the moment to think about position sizing, not about panic selling. If the pullback is orderly and the fundamentals are intact, holding your core position while being patient about adding more is the intelligent move. If you are a short-term trader who entered specifically because of the tariff catalyst, watch the political news on Mexico closely. If a deal looks genuinely likely, reduce exposure quickly. The hot money will move fast if the catalyst disappears, and you do not want to be the last one out the door. And if the data changes, if gold breaks down, if physical demand evaporates, if economic data signals a hard landing is genuinely unfolding, then the bigger crash scenario becomes more real, and patience becomes more valuable than action. This is not a binary choice between buying everything right now or waiting on the sidelines forever. This is about building a position intelligently, in stages, with clear conditions defined in advance for what would change your thesis. The investors who build real wealth in markets like this one are not the ones who call the exact bottom. They are the ones who understand the structural story well enough to stay positioned through the noise, and who manage their risk carefully enough to survive if the noise gets louder before it gets quieter. Silver is not a lottery ticket. It is a wealth protection asset at a moment in history when wealth protection has never mattered more. Treat it accordingly. The dip is real, the opportunity is real, and the risk is real. Now you have the framework to navigate all three. If you want more deep market analysis like this, honest, structured, and built on real mechanisms rather than hype, subscribe and stay close to the channel. Because the silver story is far from over, and the decisions you make in the next few weeks could matter for years to come.